Welcome to the Personal CFO. Today we're going to be talking about the risks that come along with the stock and bond market and how we can think about getting compensated for taking additional risk when it comes to bond and stock market investing. So typically, when you think about investments, you think, okay, in order to get a higher reward, I need to take a higher risk. And we're going to discuss how that plays out in the stock market and in the bond market, and you might find some surprising answers. So let's look at the bond market first. This chart here shows us how comparing investment grade bonds, which are typically considered lower risk, higher quality bonds, with high yield bonds, or sometimes considered junk bonds. So what makes something investment grade corporate bond versus high yield corporate bond? Well, the quality of the earnings, all the things that you might think what's going to make a company more or less risky. And as you can see, the higher yield or junk bonds have a higher rate of return by quite a bit. But it also comes with more volatility, so more ups and downs. That makes sense, right? So if we're going to expect a higher rate of return, we should expect higher volatility. Okay, so we understand that with bonds. How does this work with stocks? Well, let's look at the chart for stocks. As you can see, it doesn't quite play out like this. So when we're looking at two different comparisons, which are high quality companies and low quality companies or junk, now when you're thinking, what does that even mean? It means when you think about a company's profitability or cash flow, are they consistent? Are they increasing? Those types of metrics. So a higher quality company is going to have consistent earnings, it's going to have consistent cash flow, low leverage, and a lower quality company is going to have the opposite. And you might be thinking, okay, if I'm going to go invest in one of those lower quality companies, I should get compensated more, and history should show that. Well, it turns out in the stock market, that's not the case. And higher quality companies actually come with a higher return and less volatility. So how does that play out? Like, why is that? And there's a pretty simple explanation that I think is going to make sense. So when the markets go up, as you can see, the higher quality companies and the lower quality companies, they're pretty close, right around that 3.5% mark for rate of return. So when the markets go up, high quality companies go up, low quality companies go up, and while low quality companies go up a little bit more, it's not that much more. But what happens when the market goes down? Well, this chart here shows us that. And when the markets go down, high quality companies go down some, but low quality companies go down a lot. And so the ups are similar for both types of companies, but the downs are quite dramatically different. And so Warren Buffett famously said, when the tide rises, it lifts all boats, and it's not until the tide goes out that you see who's swimming naked. Now, that applies to when you're buying high quality companies or low quality companies. The reason that it's different than the bond market is with stocks, when the markets go up, everything's pretty similar. But when the markets wash out and don't do as great, the companies that don't have solid earnings and are considered less quality can lag pretty dramatically. I hope you found this helpful, and as always, thanks for investing your time with the Personal CFO.